Thanks for joining us today, 30th of April 2020 for Ainsley News. Today we're talking about how the US GDP just copped a whopping 4.8% downturn. Last night's headline, negative 4.8% GDP print, while worse than expected, is far from telling the real story of the US economy, itself a proxy for the rest of the world. Whilst a recession is technically 2 consecutive negative GDP prints, no one is saying this is not now officially a recession and an end to the US longest ever economic expansion. Whilst yes, negative 4.8% is the worst print since 2008, it tells only a fraction of the story, about 20% of the story to be exact. From Bloomberg, it's kind of incredible when you think about the fact that the economy was running pretty much on a normal footing for over 80% of the first quarter. When that is extrapolated and knowing what we now know already for Q2, the forecasts for this next quarter make that negative 4.8% look small. In reference to the chart below, we will clearly need a much bigger chart. From Bloomberg. The current quarter is likely to be far worse, with analysts expecting the economy to tumble by a record amount in data going back to the 1940s. Bloomberg Economics has projected a 37% annualized contraction, but UniCredit is the most bearish with a 65% estimate. This is shown in our contraction hits graph just here. The makeup of the plunge was hugely impacted by PCE, personal consumer expenditure, the worst since 1980, and then across the board with only an uptick in imports and, surprise, surprise, government spending the only positives. This is shown in the quarterly GDP chart by component breakdown just here. The market's reaction? Meh. Coincidentally, the release of the positive report showing Gilead's remdesivir virus cure progress came just seconds before the GDP print. While showing only a marginal improvement in projected mortality rates, not a cure nor a vaccine, the market decided to focus on that rather than the pesky GDP print and rallied strongly. Yet the biggest quarterly drop in GDP since the GFC, worse than expected and on 20% of the quarter in lockdown, saw share markets rally. If you needed any further proof of a bull trap rally, read our news if you need more explanation on a bull trap, you've been drinking too much Dettol. This chart speaks volumes, shown just here. But clearly not everyone is drinking from the isocol fountain. Precious metals and crypto rallied on the news. The Fed then came out and reinforced they will do whatever it takes. Cause. The ongoing public health crisis will weigh heavily in economic activity, employment and inflation in the near term, and poses considerable risks to the economic outlook over the medium term. Response. To support the flow of credit to households and businesses, the Federal Reserve will continue to purchase Treasury securities and agency, residential and commercially mortgage-backed securities in the amounts needed to support smooth market functioning, therefore fostering effective transmission of monetary policy to broader financial conditions. Effect. The Federal Reserve is redefining central banking by lending widely to businesses, states, and cities in its effort to insulate the US economy from the coronavirus pandemic. It is breaking century-old taboos about who gets money from the central bank in a crisis, on what terms, and what risks it will take about getting that money back. This was courtesy of Wall Street Journal's Fed Watchers on John Hilsenrath and Nick Timorous. Denial. The debt is growing faster than the economy. This is not the time to act upon those concerns. Literally from the mouth of Jerome Powell, chair of the Federal Reserve, in his press conference last night. The problem is neither the Fed, the US government, or nearly any other central bank or government in the world today seems to think this rampant accumulation of debt and debasement of money is a concern. People are buying up gold, silver, Bitcoin, Ethereum, etc., for that very reason. Debt always eventually matters, as does economic reality for shares. Well, thanks for listening to news today. We look forward to presenting more news tomorrow.